What's up, guys? Welcome to STN's Risk Management with Ricky Analog. Want to start out with a disclaimer, real quick. Nothing in here is a recommendation, so make sure to familiarize yourself with our disclaimer. It's in the description of the YouTube video as well as on your screen. This is all for informational purposes only, and it is very important that you recognize trading is inherently risky. And I realize the irony of saying that right before doing a webinar on risk management. I just want to start off by saying that if you're part of StockTraders.net, you by now must have noticed that the owners and the moderators uh, really care about people, especially their members. And Titus, MT, Goose, and Rob all have proven that they are here for you guys. And I'm deeply proud of the fact that they thought of me as someone worthy of being a part of that team and that mission. I too care about all the members' success and growth, and that is exactly why I felt it was so imperative to do this webinar. I'm Ricky Analog, and many of you know me, but for those that don't, I'm a moderator here at StockTraders.net. I'm a technical trader that uses fundamentals to help gain conviction on short positions involving shady microcaps. But I also trade many large caps as well. And so I want to spend some time today trying to teach you guys my personal views on risk management. Now, before we get started, just want to let you all know that if you're watching this live, there's going to be about a 20 to 30 second delay. So if you're typing comments or questions in the chat, it's going to take a little bit before a response can be issued. But I do hope that you guys type your questions in the chat so that we can get to them towards the end. Let's take it back to the beginning. What is it you think is the single most important thing to accomplish in your first year of trading? Is it to double your account? Is it to be able to quit your 9 to 5? Is it to prove to Twitter that you're trading's golden boy or golden girl? No, it's not. Your first year of trading should be focused on one thing and one thing only: surviving. Surviving? Yes, surviving. Have you ever stopped to think for a minute about who the participants are in the market? There's a great quote that says, if you're playing a poker game and you look around the table and you can't tell who the sucker is, it's you. This is extremely true in the market. Nowhere will you find something where the stakes are this high. The game brings all types of different players to the table. The first thing you need when you decide you want to learn a trade is a rough dose of reality. There are some extremely smart and savvy people out there, and if you think you're just going to be able to waltz in here and take their money, you got another thing coming. The sharks out there wake up every morning just thinking about all the new idiots coming in the market to make a donation. So then how do you survive? Well, there's 3 key elements that if you don't learn right away, you're most likely going to blow up your account. The first thing you need is a strategy. There's a ton of different ones, but you must have one. For most people, this will also be synonymous with your edge. I say for most people because your strategy is not the only edge you can have in the market, but that's a whole different webinar. One giant problem, thanks to Twitter, is that most people think they have a strategy when they really don't. And just to clarify what I'm talking about so there's no confusion, shorting the front side of parabolic moves is not a strategy, at least not one that's going to let you survive for very long. I'll show you why later on in the webinar. The next thing that is crucial to your survival in the first year is trade selection. People in their first year tend to get trigger happy and think they need to run around and be in every trade. Again, I think Twitter is to blame for this. Not all trades are created equal. Last, but in my eyes, most important, is you need to learn good risk management. So why is risk management the most important thing? Well, because you can most likely get the first 2 things, strategy and trade selection, all wrong. And as long as you have bulletproof risk management, you'll most likely make it through your first year of trading. And after you've been around a year or more, you're going to start to learn more about strategy and trade selection, but the name of the game is longevity. You will never learn a good strategy or have time to learn about good trade selection if you don't give yourself the chance to be around long enough. So one thing every single one of you needs to do, if you don't already, is journal your trades. I can't even begin to explain to you the vast number of benefits derived from it, but there are a few that must be noted. First, you will be able to actually see key statistics. A few you need to know about your strategy is your win rate. This is the percentage of winning trades you have to the percentage of losing trades you have. You also need to know what your average winning trade is, profit, and your average losing trade loss. If you take your winning percentage and multiply it by your average profit, and then from that subtract your losing percentage multiplied by the average loss, you will find out what your expectation is. If this number is negative, your strategy is going to lose money over time. And vice versa. If it's positive, you should find yourself profitable over a longer sample size. There's only two real factors involved in that equation: your win rate and your average profit versus loss. It's not always easy to increase your win rate, but skewing your average profit versus loss is completely controllable through risk management techniques we'll be going over. So let's look at the examples I used here. The first example is a win rate of 50-50. It's pretty easy to hit a 50-50 win rate. I mean, probably flip a coin, and people like to act like they can predict what stocks are going to do, but no one really knows. So a 50-50 win rate is pretty easy to have. But in this scenario, we have an average win of $500 and an average loss of $250. So it gives us an expectation of $125, meaning that if you let this strategy play out over a long sample period, you should average about $125 per trade, meaning you're profitable. Now, you're going to have some that are bigger wins, you're going to have some that are less, you will have some losses. Obviously, it's a 50-50 strategy, right? But the next example is a high win rate, 80%, but your average win is only $200, and your average loss, even though it's very seldom, is $1,000. So your expectation is actually negative, meaning this strategy will not be profitable in the long run. So the last one is a really low win rate, but very small losses, taking paper cuts, and when you do have the win, it's a big one. And you can see, I had to use extremes to kind of illustrate the point, but even though you only win 1 in 10 trades, you're still profitable. So that just shows you the power of risk management, because that is how you get yourself to where even with under 50% wins, you can still remain profitable. So as far as journaling systems go, there's plenty out there. I currently use Edgewonk. I love it. There's also TraderView, which I haven't tried, but I've heard great things about. Or you can simply create your own Excel sheet and track your own trade statistics. It's not as hard as you may think, but whatever you choose, you must do it. There's no way around it. You have to journal your trades. So let's strip risk management down to the basics. If your strategy does indeed have an edge, meaning that if you let it play out over a large enough sample size, it'll come out ahead, even if only slightly, then risk management is the tool that we use to ensure that the times it's working, it works to its fullest, and when the times it's not working, it lets us get out of trades with minimal damage. So what is risk? Risk is, and it needs to be defined this way, it's important that I define it for myself this way. Risk is the predetermined amount that will be lost on a trade if the trade goes against you and hits your predetermined stop loss. What was the operative word in there? Predetermined. Well, that's because you should never be entering a trade without 3 things planned: your entry, your stop, and your first target. We've all heard the cliche that you need to let your winners run and cut your losers quick, right? But oftentimes nobody explains to us just how to do that. How do you cut your losers quick? Let's ask this. Which scenario loses more money? A 100-share position going against you $1, or a 1,000-share position going against you 10 cents? They're the exact same. But what's the difference? Well, the person with less shares has more room to let the trade play out. But you might be saying, well, the person with more shares stands to gain more if the trade plays out in his favor. Yeah, true. But you need to get out of the mind state of focusing on how much money you could make. Your focus before entering every single trade should be on how much can I lose? And what are the ways to control how much you lose on a certain trade? Well, as traders, we only have 2 mechanisms at our disposal. That's our stops and what position size we take. So they're both extremely important, but I also personally believe they're grossly misunderstood. When I talk to many traders about their risk management issues, I'm usually taken back by how much size they're using, especially for the account size they're trading. Not only that, but when you ask them about a specific trade and why they chose the spot they stopped out as their stop, they often say something stupid like, well, that was 10 cents from my entry, and since my max loss on a 10K account was 1K, and I had 10,000 shares, that's where I had to stop out. Are you kidding me? There's so much wrong with that statement, I almost don't know where to begin. But I get those kinds of things all the time. So I've included an Excel sheet that's over at stocktraders.net that I've created that allows you to calculate correct position sizes. It's also got a few widgets I built into it. It's all free. Just head over to stocktraders.net, sign up, and you will find it there. But first, we need to go over how it works and the philosophy behind it. So, second, close that window out. Looking at the Excel sheet, you'll notice that you need to fill out your account size in the green cell. And you might be saying, well, why your account size? Well, that's because good risk management starts with the assumption that you should never put more than 1 to 2% of your entire account's capital at risk. Let me be clear. This does not mean that if you have a $10,000 account, that the largest position you should take is 100 to 200 bucks. We all know that would be ludicrous. But what it does mean is that if you have a $10,000 account, the largest loss you should ever take on that is like 200 bucks, which would be 2% of your account. Now, I definitely lean into trades from time to time, but it stems from experience on certain setups being A+, and other things that may warrant it. There's also ways to increase your position size through ads at strategic spots where you don't actually take on more risk due to the fact that you're able to move your stop down or up, depending if you're long or short. This Excel sheet, however, is based off of 1% total cap risk, so if you want to change that, you're free to. It's your money, but remember, this is all about longevity. So second, something I see far too many people get wrong is they pick their position size first, and then they figure out where they would have to stop out in order to be respecting their full risk of 1%. Well, that's completely bass backwards. You need to learn how to properly set your stop loss. The very best piece of advice I can give you for setting rational stop losses is look at the chart, look at your strategy, and ask yourself, where does price have to go to show me my thesis is wrong? Well, just outside of that is where you should set your stop. Once you have your stop loss and your entry, now you use the sheet to determine what the proper position size is for your trade. You'll notice there's 4 different risk levels in the chart. There's a full R or big R, meaning full risk. And then the other 3 are fractions of that, 2/3 risk, a half risk, or a third risk. And depending on whether your setup is A+ or not, or you're just trying to grab a starter position, you're going to want to pick the level of risk accordingly. So as I said before, not all trades are created equal. I've also included a widget that will help you calculate your average cost basis in case you're entering at partials at different levels. And also a thing underneath that that lets you play around numbers to try to get close to a full level of risk while adding. And I did this all because I was just feeling like an extremely nice guy. Anyways, we'll be using this sheet for the examples that we'll go over throughout the rest of the webinar. I just want to let you guys know I'm going to use a $35,000 account as an example account because that is what I recommend people start trading with, if not more. It gives you wiggle room to take some losses before you ever become in danger of a PDT. And obviously I've heard and I'm aware of the different ways of skirting that through trading things like SureTrader or, I mean, some people want to start early and want to use like a $5,000 account without the PDT, but there's so many reasons I could argue against that, but again, something that's better probably saved for another webinar. So let's move on to our first example. We're going to use this Excel sheet with some charts, and we're going to go over some plays. So the first chart we're going to pull up is Snap, and we will actually use, for the first example, we're going to use the big run on earnings day. So I'm going to scroll back a bit, and we'll mostly be looking at the intraday. I just want to point out real quick on the daily chart here that this is the breakout level you can see marked here in the pre-market, which was at like $16.95, and that'll kind of come into play in the explanation a little bit here in a second. We'll make this full size. So Here's the Snapchat chart. They had earnings after hours, and then this is the next day. And so this chart, the reason I picked this one as an example is because I think it illustrates really well what kind of position size to take, as well as where to place your stop, and even how to add later on when it is to your benefit. So there's multiple different strategies that would have all given the same long trigger on this opening setup with Snap. Titus shared one just the other day in his midday Titus talk where he discussed a very simple yet effective opening range break play. And so you can see this has been consolidating all pre-market, and it's even started to put in some higher lows. It's forming a nice tight flag or coil or whatever you like to call it. The point being, when it opens and has that slight pullback to the daily chart breakout level that we were just discussing, it holds and then breaks north of the pre-market consolidation. You have your trigger for a long. Now, something worth noting is that, as always, it would have benefited most if you were watching this pre-market with this already planned out. You told yourself, okay, if it breaks consolidation area at like 1728, I'm getting long. First thing you need to determine is, where does the stop go? Where would price have to go to show me I'm wrong? We played this as an opening range breakout, so if price were to go back through the opening range or opening prices, to me that's enough to show me I'm wrong. Also, just below that is the daily chart breakout spot at 1695 or so. So to give it ample wiggle room, I would set a stop at 1689. Now, if you have this all planned, you know that you're willing to take it long at 1730-ish, and you have 1689 as your stop. Now you know that we have a, 40 cent stop loss, or 40 cents wide stop. Now go to your Excel sheet and let's see what position size we have to take. Well, you can see that 40 cent stop coincides with 875 shares at full risk. And for most of the examples here, we're just going to use full risk, even though it is going to be up to you and your discretion as to the quality of the setup and how much size you feel comfortable taking. This is just how much your max position size should be if you're thinking that you want to take this with full risk. So it's a full R, we take 875 shares, and in this scenario, the first target is going to be the, let's go back to the chart. It's going to be the post-market highs from after they announced the earnings, which is 1837-ish. We'll just call it 1837. So with that target, you are getting 2.5 to 1 reward to risk, which is great. So let's say we take half off at the target. Actually, let's just say you lock in 400 shares at 1837, we said. So you've locked in about $400. And after that, my suggestion would be to lock in more at each whole number, maybe even half. But these bigger names that are really moving tend to really obey and act as magnets to these whole numbers. So let's say you take another 200 shares off at 19. So you've already locked in like $750, and you're still sitting on 275 shares. And you can trail those out however you see fit. There are actually some spots you could have added as well and even moved your stop loss up. So like, we know that stocks trend, so you have to have higher highs and higher lows. So you finally get a pullback, and when it breaks that, you could have added shares there and then moved your stop up to the bottom of that low. And as you can see, you would have never stopped out. But let's just keep this conservative and say that you lock those last 200 shares in, or those last 275 shares in somewhere in the profit zone. So you pretty much banked 4 figs on this, and you only ever risked $350, and you never even put on more than 1,000 shares. So let's check out another chart. For the next example, we're going to do RGSE, and we're actually going to do, I'm going to show you guys a neat little tool on Thinkorswim. If you don't know about this already, it's called On Demand, and it lets you go back in time and replay different days. So we want October 5th on RGSE, and you can play the whole day out. I usually just set the time till the end of the day, and I don't let it play. I just want to see what the intraday action was throughout the day. But it's a super powerful tool. So as you can see, Now we have this is that giant run where it went from like 80 cents to a high of what, 320, looks like 325. So it was up over 300% on the 4th, and we're looking at here on the 5th, and this thing was an epic short, but you had to have good risk management to realize it. So let's just zoom in on this and let's go through it. So the way I would have played it, we know things trend, and we know the day before we had higher high, higher low, higher high, higher low. It wasn't until towards the end of the day we got a lower high, and we have this low here. So 280 is kind of our trigger, but it cracked right before the end of the day. So there's no way I was going to take this. But you have to look at markets as a never-ending cycle. So when it picks up to the next day, prices should still kind of be obeying the same resistance, support, and if that truly is the beginning of the backside, you can pretty much use the high of this push, which is 309. So I would put a stop at 311, and you can short anything that pushes up towards these levels with pretty minimal risk, because we're saying here's something that was up 300%. It should have some substantial backside. So the thesis is that we're on the backside, and we want prices as close to this 280 level as possible with risk on 311. And as you can see, you get that push. We get a push right up into those levels. You could have took shares at 280 using 311 as your risk level. So it's a 30-cent stop loss, and you have to know where your target's at. So first target for me would be the pre-market lows or the whole number 2. And so you got about 80 cents to your first target. Reward to risk is good, so all systems are go. So how do we correctly size into this? This is where we go back to our Excel sheet, and we said a 30-cent stop. So we're looking at 1,167 shares, and we're just going to make it 1,100 to keep the math a little more simple here. And let's see. So let's say we took 1,100 shares at 280, and our first target is 2. I just want to mention that indeed you can tell it was the backside. In hindsight, everything looks great, right? But this is where really having faith in your strategy and conviction in your first target is super essential, because stocks don't travel in straight lines. They trend. They move up, they move down, but if they're in a downtrend, you're going to have your lower highs and lower lows, and an uptrend vice versa. But you have to be able to have conviction. And whether that comes from fundamental analysis or just your strategy's been repeated so many times that you know this strategy works, whatever it is, you got to have that faith in it. And you also know that you have solid risk management, knowing that your target's 80 cents and your stop's 30. So maybe it doesn't work. Maybe this stops you out, but it was worth the risk, right? So you take your position, you continue to monitor it, and I use the 5-minute time frame for monitoring whether something is trending up or down. I think if you stare at a 1-minute chart and watch every single tick, or stare at the time in sales along with L2, you're really going to have a hard time holding to your target. So I'm telling you, all you really need to do is monitor the chart. Everything you need to see and know is right there. So let's assume you have faith in your strategy. We're going to take this down to 2. And I always recommend covering at least half at the first target. Get paid for your discipline and perseverance. So let's say you take 600 off at 2. You locked in almost $500, and you're still rocking another 500 shares. So for me, the next logical target is the pre-market lows of the previous day, or not pre-market lows, I'm sorry, the previous day's low, which I have marked on my charts here is the yellow. The blue line up here is the previous day's high. This dotted line is the open, and this white line is the previous day's closing price. So the next logical target for me is the previous day's lows. And we don't know if it's going to get there or not. But until it starts to make higher highs and higher lows, a trend reversal isn't even possible. And do you see any higher highs or higher lows on this chart? You don't. You would have been able to damn near get previous day's lows right at the end of the day. There would have never been a time when the price action was telling you that you should get out. So let's just say we took the last 500 off at $1.84 or so. You just locked in almost $1 a share on your last 500. So you almost banked another 4 figs, and again, only risked 350 shares or 350 bucks. So this is the power of risk management. So I know what you're thinking. These are examples where your trades worked out. La-di-da-di. Well, let's go look at one where we would have stopped out and see how risk management works in those scenarios. So let's pull up XNet. And I'm actually going to use, I think, what was it? November 21st is the date I want. And if you haven't caught on yet, these are the trades I've taken. So most of these are experience that is speaking here, guys. So let's see. Here is November 21st. This is the 5-day, 5-minute. So I'm going to pull out and go to all my time frames, and you can see why we were stalking XNet. This move was currently underway, and you can see it was set to gap up. And then when it crapped out like an hour before open, I really thought today was the day, and so I started preparing for my plan. And let's make this full screen. And let me show you what I did, guys. So when it pushed up with that first 5-minute candle and rejected right into the 5-minute 20 and the previous day's highs, I decided to put on the short. I shorted right around 19. So where was my risk at? It was right over top of the high, the opening 5-minute candle. And since 20, the psych level 20 was right there, I put my stop at 20.11 to give it some wiggle room in case the psych level held, which that's another webinar. Psych levels, 20, 10, 100, those things tend to act as good support resistance. But also notice that, like, if we do break that high, we've put in a low, we've established a higher low. Here's your high. You break that, now you have a higher high, you're in an uptrend. So it's not somewhere you want to be short. So it wasn't really an A+ setup for me. I don't remember if I had full risk on or not. But like I said, we're going to keep things conservative and simple for the sake of the webinar. So we'll just say I took it as full risk. So I had $1.10 as my risk. So let's go look at the chart here. So $1.10 would have been 318 shares. Let's just keep it simple and use 300. And so I had 300 shares. I stop out at 2011. I'm down 330 bucks or something, which is nothing on a 35K account, which is what's important to keep in mind. But look what happened if I didn't have good risk management. This thing went to 24. You know what the rest of Twitter was doing that day? They were adding and adding that whole way up. So if you take 300 shares at 19 and it goes to 24 and you're still holding those same 300 shares, those 300 shares are now down $1,500, which is way more than you should be losing on a 35K account. Now imagine you added shares at each whole dollar. It's not hard to imagine how much in the red your unrealized would have been. And I know some smart ass right now is saying, well, look how well that trade would have worked out if you held and added. Let me ask you this. Is money the only form of capital? Is it the only thing that takes a beating when you are down on a trade? What about your mental capital? What does an unrealized loss like that do to your mindset? It's not worth it. I'm telling you right now, and I don't give a, you know what, how well that trade would have worked out if you held and added. It's mathematically impossible that it could have ever worked out better than if you simply waited for the backside and then hit it with all those same shares. First of all, your original 300 shares would have never gone green on the day. On top of that, you're not even guaranteed that this thing will reverse. So the last thing you need is the add to the front side mentality, and then it turns out to be the next KBIO or Drives or DCIX or you name it. Risk management is what keeps you in the game for the long haul. And you need to know what I did, or I want to tell you guys what I did after I stopped out. I went to the gym. I wasn't even upset. Just going about my normal day. Wasn't a big hit to my capital or my mind state. But while I was at the gym, I checked my phone. I saw that the setup was telling me that the backside was coming or it was here. I mean, we had a nice big down move, lost the 5-minute 20, and I actually got short at 12.25, and I knew that I was kind of shorting in the hole, and so I only took a third size, and I knew that my risk was over 23, and I told myself, with the third size, I want to get full size, but I'm going to wait till as close to 23 as I can get, and I'm going to add, and I did. And I think I had full size with an average of about 22.60, and I covered a third at 21.50, a third at 21, and a third at 20.50. And I made back much more than I lost on the initial short. And that's why risk management is so important. And you know what? I never once stressed over it. I was at the gym having a good workout, enjoying my day, while everyone else that was adding was probably losing their mind, you know. And everybody's been there. If you haven't, you don't want to be. And I know what you guys are probably thinking, that making like $500 to $1,000 on a trade doesn't sound very flashy. I mean, come on. We all got into trading to make 5 figs a day or more. Or some of you even might be trading a smaller account, meaning that you are making a lot less than that if you're using the risk management techniques that I'm showing you. Well, I got a news flash for you. The ability to size into trades and make 5 figs a day is earned. You don't just show up with a $5,000 account and immediately start banking like the guys that trade with larger accounts. You need to have lots and lots of little base hits sprinkled with a home run here and there that add up. And eventually, you're going to see your account start to grow. And slowly but surely, and most importantly, safely, you're going to be able to take larger positions because your account is larger. It's also important to point out that if you use risk management religiously and your account still constantly loses money over the course of 4 to 6 months, it's safe to say that it's probably your strategy that has a flaw. And the good thing about this is now you can objectively look at that and say, I need to go back and something needs to be fixed. So for the last example, I want to point out that risk management applies to all trading, not just day trading. So let's do a swing trade example. Let's take MRNS, and I'm going to turn off the on-demand because this one is actually recent. So let's look at the daily for this one since it's a swing trade. And you can see that it's been making higher highs and higher lows up until recently. Around 12.29, it put in what appeared to be a lower high. And then on 116, it confirmed that or validated it as it made its first lower low on the daily chart. And I just want to point out that you guys can also use things like weekly charts to look at stuff like this. And you still see the same higher highs and higher lows until here, and now we have lower highs and lower lows. So let's go back to the daily. This could have been your entry trigger on the trade, and you could have either took it right at the trigger of 685 or waited for even better prices. But let's just assume you took it on January 16th at 685. Where does your stop go? Well, as long as the price doesn't get above 877-ish, then you will not have had a higher high. So you need to use that as your stop. Swing trades often have much wider stops, so they have to be played with much smaller size. So again, let's pull up the Excel sheet and find out what our risk would have been. And it's about $1.95 of wide on the stop loss. So we're looking at 179 shares. And this is, I think, an example where it's justified to say, look, you're not anywhere near your stop. If you're going to take some shares at the trigger, it should be max probably third size. So we're going to say 60 shares at 685. And let's go back to the chart. This way, so if we took 60 shares here, you can see that you got a lot of room up here to add as it approaches 8. You know, you're using 877 as your stop. So that way you can kind of get your average cost closer to the risk level. And you can see we could have easily added shares at 8 and still kept our risk at a full R and gotten our average to a much better area. It's important to understand that this is not the same as adding to a loser. As long as your stop hasn't been hit, the trade's not a loser. Now, if you hold past your stop and you add, then my friend, you are adding to a loser and you're bound to have bad things happen. So let's just use the average price calc now and the how close to full R widget, and let's figure out a good amount of shares to add at 8. And I'm going to teach you guys how to use these functions here. So we have 685, there's our entry price, 60 shares, you have a stop loss of 877, and we're trying to figure out at 8 how many shares can we add. So this number here, the closer you get that to 0, the closer you are to full risk. And you'll see that decrease as you put shares in at 8. So let's just see what 200 shares at 8 gives us. So that gives us an average cost of $7.73, and you can see this number has come down to 80, so we're not quite at full risk. Let's see what happens if it's 300. It's much better. So now you have an average cost of $7.81, and we're almost at full risk. And so you know we don't even have a dollar wide stop here, and the target for me on a stock on a swing trade like this, the first target is going to be probably the psych level of 5, and then next would be the 200 moving average on the daily. So you got over almost, it's pretty close to $3 of reward if it plays out in your favor with using about $1 of risk. And the best thing about this is you're still only risking 1% of your account. Like if this thing stops you out, you're losing 300 something bucks. It's not the end of the world. Let's see, so you can see that, I also want to point out that the price after you get that ad at 8, we're just assuming that this is how it's played out, you may have been very tempted to be locking in profit on the way down. I tend to subscribe to the philosophy of first target or stop loss, one or the other. So for me, I'd be holding to 5, or I would get stopped out. But it is okay, I think, in swing trades like this to be locking in some and then adding on pops. So like it's called trading around a core. It's a very common practice, and it's basically on shorts you're selling the pops and covering on the drops, and on longs you are buying the dips and selling the rips. But that is the last example I have for you guys. I just wanted to point out that rational and mathematically sound risk management opens up a whole new world of possibilities, as well as helps to ensure that your longevity in this game is not short-lived. That concludes everything I got prepared for you guys. I'm hoping that this brought value to you guys, and I really want you guys to go and check out stocktraders.net. I mean, we are over there every day doing our thing. There's a ton of great traders in there. All the moderators and the administration are down to help out in any way they can. So hope to see you guys over there. Peace.